Hello and welcome everyone. This is a special webcast we have put in together entitled Market Outlook, Views and Strategies During COVID-19. I am your moderator, Mary Love Alex, Head of Marketing and Product Development, and I'm here with Mr. Edser Trinidad, First Vice President and Head of Investment and Research of First Metro Asset. Hello, Edser. I will turn the time over to you.
Thank you, Mary Love, and good day to all. Basically, thank you for giving me the chance to give you our views about the market and what will be our. We can also share you and give you some insights on um, our strategies going forward. In the past, the Philippines has got a really lot of challenges, and be it natural calamities or the global financial crisis. And um, despite of those crises, the country has been resilient. And we believe that this crisis will be no different, that the country will bounce back possibly stronger than ever. And what are the reasons why we believe that the country will be one of the first countries that will recover in this COVID crisis? First, um, the Philippines has a strong financial position to fund necessary projects to spur recovery. Second, it still has the fiscal and monetary space to provide and to support growth. We believe that the weakness in crude oil prices, which has affected the markets the past couple of days, will outweigh the risk, or rather outweighs the benefits it can bring to the country as compared to the risk. We also would like to point out that despite of this crisis, the country's strong fundamentals remain intact, and we will explain this for in much detail with the next couple of slides. For the equities, the market drop has bring down valuations to a more realistic level. While we expect to see volatility to remain high, we believe we've already seen the worst as the policy and required reserve ratio cuts and planned stimulus program should ease concerns about severe economic pain. For the fixed income, the supportive policies introduced by the BSP and the government helps calm the initial sell-off, and yields have come off to their high. The repurchase being made by the BSP and the cut in triple R and policy rates, as well as the plunge in the oil and commodity prices, will pull down the yield curve further. I think we believe that the only risk to our view is a prolonged ECQ due to the potential second wave of infections here and abroad. So, just a bit of some update on what's happening on the our COVID cases here in the country. We believe that this is basically the most common chart that most of our media outlets have been showing. And, you know, giving out this chart is, brings in, a very negative message, considering that it shows that the cases had continued to rise. But if you dissect this and look at the everyday number of cases that is being reported, it shows you a different picture. And as you can see on this following chart, there's basically some trend is already building, and this trend looks promising because it shows you some declining trend. Although, admittedly, the data that is being currently shown is still limited to provide a conclusive conclusion. And we believe that decision by the government to extend the quarantine or the ECQ to another 2 weeks is a prudent move for the government in order to provide a very good set of data. Looking at the number of recoveries vis-a-vis deaths, it is also quite encouraging to see that the recoveries outpace the number of deaths. And if you are going to compare, our case as compared with other countries here in the region, let me show you this following chart. As you can see, varying degrees of, success. You see Thailand and Malaysia have shown a tremendous decline in COVID cases. This is because they're, I think, one of their first countries or two of the first countries that have really implemented a quarantine on certain areas where there's a high incidence of COVID-19 incidents. And this is the reason why they're able to control the cases. And if you are going to look at Indonesia, Indonesia is far concerning because cases have been rising. Um, I believe that this is basically due to a factor that we faced before, that there are a couple of few uh, testing kits. In addition, the the quarantine policy is not as stringent as our policy. And if you are on the other chart, is Singapore. During the initial months or weeks, you've seen COVID-19 case in Singapore seems to be, controlled. But all of a sudden, there is a spike in the number of cases. But this seems to be quite alarming. But if you are going to look at real cause, it's more manageable because these happen on certain or concentrated in certain areas which they can easily control. So, as I said, the country is in a very good financial position to fund their rebuilding for the following reasons. First, it has a lot of option to or room to borrow without putting a big debt to our finances. If you look at our debt to GDP ratio, we have one of the lowest in the region at 41%. What is quite also worth taking note that our external debt is just about 14% of GDP. I believe that um, a lot of people had misinterpreted of what President Duterte has been saying, that the government doesn't have the money. What he wants to convey is because COVID-19 is not basically part of the budget, it hasn't been budgeted. Therefore, the allocation for COVID-19 is basically non-existent in our budget. So it's more a matter of allocation of budget, allocation of money. It doesn't necessarily mean that we don't have the means or way on how to fund our COVID-19 cases. And as you can see, the following chart, this gives you a graphical chart on our debt, both externally and domestic. And as you can see, if you look at the pure gross amount, it's rising, but our economy is rising faster than what we borrow. And this is the reason why debt to GDP ratio is significantly low as compared in the past. Um, Historically, our debt to GDP in total, external plus domestic, has reached to as high as 80%. Now, because of our faster growth in our economy, our debt to GDP is now at about 40%. And if you are going to compare this to our neighbors, we're basically better off. as most of our neighbors, or a big number of our neighbors, have a very high debt to GDP. Now, what's the impact of having a very high debt to GDP? It offers any government a limited option to borrow money because they're heavily indebted. It's just like the company, whereby your borrowing is like more than what you have as an equity. And that is basically very difficult for anyone in that kind of situation to borrow more money because banks are not willing to lend money because they're fully extended. So this is basically like um, gross gross debt to GDP level. If you have a very high debt to GDP level, it's either creditors are not willing to lend you more, or they're going to charge you a very high interest. Fiscal balance. This chart shows you that our fiscal balance is actually better than our neighbors. Although lately our fiscal balance, our negative fiscal balances, has been growing. But this is basically due to our spending, as we're trying to um, invest more in our infrastructure, and this is the reason why we have to invest more. But this is basically a very healthy level, which it is manageable. We are because of this, even though the government will increase its spending in order to jumpstart the economy or fund our war against COVID-19, we believe that the fiscal balance will remain at a manageable level. And looking at our fiscal and monetary policy, um, we believe there's still a lot of room for further cut, and that should encourage, to stimulate the economy. So by further lowering policy rate, the policy rate is practically the guiding rate, which banks where banks use it as a gauge to price their interest, or to their customers. So the lower the policy rate, it means that the guiding rate of the banks will be lower. So therefore, the pricing of interest rates will also be lower, and that also encourages companies to borrow in order to fund their expansion or the rehabilitation. Same as the reserve required ratio. This ratio is basically how much of the bank's deposits is being kept in central bank, or BSP. And this portion of their deposits doesn't earn anything. So the more money you release on the market, so these banks will be forced to deploy this money, because in order to make this money be, be productive. So this will encourage banks to lower the interest rates in order to encourage businesses to borrow money, and that should help, you know, jumpstart or restart the economy. So in terms of the crude oil prices, and this has affected the global market during the past couple of days. While I have to admit that there might be some negative on the weak crude oil prices, but our benefit outweighs any potential negative that will result in this event. In terms of the negative, as a big number of our kababayans are working in the Middle East or oil producing countries, because of the lower oil prices, this will force oil producers to cut back expenses or to cut back in their investments, and this may entail some potential retrenchment to our kababayans. But the potential benefit outweighs um, the negative, of the because we are a net importer of fuel. We depend for our fuel needs to the oil coming from the oil producing countries. So because of a lower crude oil prices or lower fuel price, that means will be enjoying a lower transportation cost, which is basically one of the major factors or on our inflation. And because of that lower inflation, that means there's less pressure for BSP to increase their interest rates, and it gives a lot of leeway for our central bank to do some further cuts on the policy rate. In addition, because oil or fuel accounts for a significant portion of our import bill, it means we need to spend lesser in importing fuel. And that will also allow us current account deficit to be manageable. Why is it important to control our current account deficit? Because this entails some effect on our currency exchange. So the higher the current account deficit, it means the more pressure for us to release more greenback or more dollar. So that will affect our exchange rate. So, but with the very manageable current account deficit, that will allow us our currency or currency to be stable relative to the US dollar. So again, this is basically the current account deficit, and as you can see, um, the past couple of years, we've hit a negative or deficit. But this is the main reason why, because there was a substantial increase in imports, in importing capital goods, meaning more equipment, and that is also positive in our economy in the long run, because those equipment will translate to more productive, will be used for more productive use. So again, this shows you the chart and the trend of OFW remittances during the past 20 years. And as you can see, this chart also, we've also have seen a lot of crisis, specifically the global financial crisis during the 2008 and until 2010. And despite of this, our remittances has been resilient. So we are quite confident that we're hoping that this might be the case, although this event may be quite different because the extent of slowdown is basically felt throughout the world. However, there might be some change in potential structural in terms of our manpower needs because of some increase in demand on certain sectors. One of the fine example is in terms of medical care. Because of this crisis, there should be an increase in the number of nurses and doctors that are being hired by hospitals here and abroad, and that should also, that should help mitigate the impact of the potential layoffs of other capabilities in other sectors. And as I mentioned about our fundamentals being intact, one of our key strengths right now is our demographic, our age. We're saying that we're basically in a demographic sweet spot. What does that mean? It means that a big portion of our economy, which is being shown here on the left side, are at the working age. So what does that translates? So the more people in the workplace, that means the more people that have money in their pockets. So there's basically an increase in spending. So and historically, every country that experiences this kind of curve or formation enjoys a very strong economic growth for 10 years. We've already seen this in Japan in I think 70s and 80s, China during the early 90s, Thailand. But they're now basically experiencing some problem in their population because of the aging population. And the replacement ratio is really low, that it will be a problem in the next couple of decades. As you can see, China, because of the very low birth rate in the past, that has resulted in a slowdown in their replacement rate. And in a couple of years, a couple of decades, a big portion of their economy or of their population will be at the elderly stage, and that will become a problem because who's going to take care of them if there are lesser people in the workplace? Now, Japan is also facing this problem, and it's in a bigger problem as compared to China because as you can see, their age population between 0 until 15 is significantly low. So it's now becoming a problem in China and, or rather in Japan, and that also affects their economy. So, Thailand, as I mentioned, about a couple of decades back, they've been enjoying a strong economic growth because of what we're now experiencing now in terms of demographics. But now it's becoming a problem because of their aging population, same as Singapore. And, to some extent, Malaysia is still holding up because a big number of their population are still at the working age, although this might be a concern because the low birth rate or the decline in birth rate. I think Cambodia, Vietnam, and Indonesia are also countries that have a fairly decent distribution, and basically we're also experiencing some healthy growth in terms of their economy because a lot of their people are at the working age. So this next slide shows you the forecast in terms of the ASEAN, and as you can see, um, uh, because of the outbreak, a lot of our neighbors have also cut their forecast. And as you can see, Malaysia has one of the highest contraction, about 2%, to best case of about 0.5. This is basically due to a big portion of their economy is basically dependent on exports. Um, Philippines, this is the latest estimate by NEDA. Uh, the revised forecast is between zero point 0.6, negative zero point 0.6 to 4.3, although some economies in the street are forecasting a much lower GDP growth. So looking at on the equities market, the pandemic has really taken a toll on the performance of our market. The PSEI has entered into a bear territory uh, starting March, and it has declined to as low as 4.6. We believe that we've already, I think, the 4.6 is the lowest. We do not discount that there should be some further volatility in the market. We also cannot discount the possibility of the market hitting below 5.5, but we believe that it is unlikely that it will reach the low that we experienced during March 19. One of the main reasons why the market has declined is there was a basically heavy foreign selling. Foreign investors accounts for about 57% of the country's trades, and basically the sell down, the foreign sell down is a major factor in our markets underperformance. This chart shows you the cumulative net foreign buying and net foreign flow since 2017. And as you can see, we're basically in a net foreign selling situation, beginning January. So looking at the foreign ownership, um, to be honest, this is quite a surprise data because we were expecting that because of the huge foreign selling, the foreign ownership share percentage, the drop should have been larger. but most of the companies have already experienced a single-digit drop, with only quite a handful that have experienced a double-digit drop in terms of ownership holdings. This can be seen on a positive note, because this can also be a sign that a lot of the foreign shareholders are still quite confident, or are still confident on the fundamentals of the country. That's the reason why they have been selling. So looking at the valuation now, it's trading at about 13 times. That is one standard deviation below the mean of 16 10-year average PE of 16 times. We say that the market right now is reasonably valued. It's not that significantly cheap, but it's already reasonably valued. And this 13 times PE is based on an assumption that the market's EPS for 2020 will drop by 15%. And looking at the numbers, the forecast of our partner brokers, as you can see, a lot of them are in agreement that the market or the economy will recover in 2021. Unfortunately, for 2020, we may be seeing some contraction, or the performance or the economic growth will not be that robust as what we had seen in the past. However, I think in general speaking, a big number of our brokers are looking at a bigger growth in 2021. In terms of PSEI level, in terms of forecast by end of the year, the median forecast is about 661. On our case, we're looking at about between 6.8 to 7,000. That's the base case. And for the EPS growth, the median EPS growth assumption is about -7. We're looking at about a slightly bigger drop, about 15% for 2020. Again, this is basically the policy rate expectations. A big number of our partners are looking at 2.75 policy rate for 2020. For the US dollar rate, it should average at the average median estimate is about 51 to 50 for 2020. And by end year of 2020, they're looking at a further strengthening of about 51. That's the median estimate. So looking at the fixed income, as BSP has been proactive in boosting the economic activity by cutting the policy rate and triple R, we've seen yields push to near their historic lows. And as you can see on the left chart, this is basically the current yield curve. It has drastically been down as compared to pre-ECQ announcement. So on the right chart, we're basically looking at what are our forecasts for the yield curve. And our forecast is we're looking at our bull case to be significantly lower than in terms of the short end. For the short end, and for the long end maturities, it should be within what we are currently looking at right now. Going on our fund performance, our enhanced investment policy, close coordination with our investment community and our consultant has bring us, to provide better performance on our funds this year. Due to this, we're able to outperform most of the mutual funds in the industry. Looking at the actively management for equity funds, our Save and Learn Equity Fund had a year-to-date return of negative 24.79. This is significantly better than the benchmark, which is the PSEI's negative 28.44. And this allows us to be to rank first out of the 12 mutual funds in the country. Going on our index funds are also doing well. Three of our funds are in the top four, namely the First Metro Consumer Fund, the First Metro Save and Learn Philippines Index Fund, and the First Metro Philippine Equity Exchange Traded Funds. These funds have been ranked second for the Consumer Fund, third for the First Metro for the Index Fund, and fourth for the Equity or Exchange Traded Fund. Looking at the Balance Fund, we're also been able to maintain a very high ranking. We rank fourth out of the eight, and what is also quite happy to report is, our return. We also, outperformed the benchmark, as our year-to-date return is negative 27.92, or rather negative 12.55 versus the benchmark's negative 18.69. Looking at the index fund, or rather the fixed income fund, our rank is our return is a 1.77, uh, beating the benchmark's negative 0.57, and that gives us a second place rank out of the other 10 fixed income or peso bond funds. And looking at our money market fund, we provide our investors with decent market return with a year-to-date performance of 0.95. So this, page shows you the summary of our ranking in each fund category. Thank you, and I open the space or table for Q&A.
Thank you, Edser. We will now proceed and take some time for questions forwarded by our clients. The first question is, were the government measures enough to temper the crisis impact on the economy? And how do this compare to other economies' response?
We believe that the government's response is adequate, and it's also comparable to that of other countries. Um, it's more of, although admittedly there has been some complaints of the distribution, but um, we believe that that will be manageable. Um, I think the government has still a lot of financial flexibility to raise money in order to support or to fund our recovery.
Right. Okay, the next question is, does the Philippines have enough funds to support the sectors heavily affected by the pandemic?
Yeah, as I mentioned on my first, you know, on on the first question, and on my presentation, as seen on the presentation, the country has adequate funding sources to finance the heavily battered sectors that had been affected by COVID-19. As I mentioned, our debt to GDP is low, of about 40% of GDP, and that is low for as compared with other countries, and that can allow us to borrow funds. Um, and it's also worth taking note that we are an investment grade country. That means the interest rates that will be able to avail to external or foreign creditors will be low because of our current status.
Okay, the third question is, in your view, what would spur foreign interest back to the Philippine market? And has local volume improved and sufficient to support the Philippine equities market?
Um, I think there are a couple of factors that can give
Mhm,
foreign investors confidence and be back in the country.
mhm,
First, I think they have to look at how are we going to respond or rebound from um, this ECQ, and how the government will execute all of their stimulus program.
mhm,
And I think the other, I think it's more confirmatory, is how you know the foreign investors will look at the lending activity of
mhm,
banks.
mhm,
If lending will improve, that shows businesses are now, you know, are trying to recover because loan activity is one of the very first indicators of a an economy
mhm,
recovering.
mhm,
So that's a second indicator, and basically the last indicator will be consumer confidence. If consumer confidence had shown a strong rebound,
mhm,
and then all things will fall into place,
mhm,
and that should, I think, give some uh, improved level of comfort among foreign investors.
mhm,
Right now, I think the past couple of days or weeks, although right now the market has gone back to its downward trend, but
mhm,
the strong recovery or the strong bounce back is basically being fueled mostly by locals.
mhm,
Locals, the past accounts for about 57% or a little over 57% in terms of the volume.
mhm,
But um, I had to admit that foreign investors um, are needed in order
mhm.
to push our market to higher level.
Okay. Okay. A follow-up question on that one is that what is the outlook for oil prices and energy sector?
Um, we expect that oil prices will
Mhm,
remain depressed despite of the efforts by OPEC to cut production because the main problem of the industry is oversupply. Because what happened is there was a global economic slowdown, and a lot of countries had their own lockdowns or quarantines, and that has resulted in a reduced demand for fuel, and that has also increased inventory. So as long as inventory remains high,
mhm,
then expect oil prices to be still be depressed.
mhm. Okay. And relative to that one is how would the recent slump in oil prices affect or benefit the Philippine economy?
As I mentioned in the presentation,
Mhm,
um, there's the benefits outweigh the potential negatives of a very of a low oil price. Um, First, um, let's tackle first the negative. Definitely, some of our kababayans will be affected because there are a big number of our OFWs are basically working in the Middle East or oil producing countries, and an low oil price would translate to potential cuts in manpower and cost.
mhm,
Uh, that's basically a negative. And on the positive is we're basically a net importer of fuel or oil, and the lower oil price will mean Our inflation will be controllable because transportation cost is one of a major costs of um, a lot of our goods. That should, allow us to have a lower import bill, which
Mhm.
will allow us to, you know, have a lower cost, and
Mhm.
that means lower inflation, and that means central bank will have no pressure to increase interest rates, and they will have a lot of flexibility on how to further boost the economy because of a very controlled or very tame inflation.
All right. Okay. We have further questions. What strategies do our investment managers take to lessen the negative impact in our investment?
Because of our, I think, our close coordination uh, with our investment committee, with our key people, with our consultant, we're able to really be on top of the situation that's happening in the market, and this is the reason why we're able to, you know, mitigate the losses much better as compared with the other funds in the industry. So going forward, our strategy is to be um, prudent on every signal that the economy or the government will provide. Look closely at the valuation or every sector and be prudent in our investment decision and be, I think, to further um, improve our fundamental capability in analyzing companies. I think those are one of our key strengths, and that has really allowed us to stay ahead of the competition.
Okay. And lastly, what would be the strategies for different risk profiles?
Um, I would. I cannot give a solution that will fit every investor
Mhm.
because this is all dependent on each investor's risk appetite. So I think the best answer to that question is talk to your relationship managers, and
Mhm.
they're in a better position to provide an investment advice on what to do. Um, because it all depends on investment risk per individual. There are certain individuals who are basically has a high tolerance of risk because they demand high return, and there are also some investors who are conservative or who have a target time frame.
Mhm.
So that's basically it. All depends on the risk profile of each investor. So it would be better for an investor to talk to our relationship manager, and they'll be able to advise them properly on what or where to invest.
Okay. Thank you. Okay, it looks like we've covered all of the questions. Edser, is there anything else you wanted to cover before I wrap up?
Well, I think my final word is, um, despite of a lot of volatility and despite of some concerns about the economy, historically, Philippines has been resilient. And I'm quite confident that uh, this will also be the case.
Okay, so that concludes our webcast. Thank you, Edser, and please
Thank
feel
you.
free to fill out the survey sent along with this webcast link. Should you have further questions, please send us a message at choosetoinvest@fami.com.ph. Again, thank you very much.
Thank you.